maybe street gives it a benefit of doubt. The thing working against Persistent is its valuation.
80% in the last 1 year. That's what the stock has done up.
Sky high valuation.
And 300% in the last 3 years.
It's done so well.
Yeah, it's done exceptionally well.
But just talking about deal wins compared to the others where your total contract values look good but don't really convert into revenues, at least their top and bottom line is better than what was expected. But it's not just IT. Today is a day where IT and banks are both in focus. Banks, of course, because of HDFC Bank. And that would be the big story this morning, really. Bunty Chawla, AVP of BFSI at IDBI Capital, is with us this morning. Bunty, very good morning. Great to have you here on NDTV Profit. Let's talk about all things HDFC Bank. The large sort of takeaway from what we've seen, what brokerages are saying so far, is that this is better than at least what we saw in Q3. Would you say that's largely your view as well?
Yeah, good morning. Thank you. Yeah, you rightly said, as there was a bit of a disappointment in Q3 with respect to margins. And this quarter, they have still slightly improvement, but it's taken as a positive from 3.4 to 3.44%. And the good part is that was taken because of the improvement in the yields, because they have taken some bit of a rate hike in some of the products, which is visible in the improvement in the yields. So it seems to be though there is a competitiveness in the yield or in the asset side, but they have taken that as a positive in terms of improvement in the yields, which is reflecting in the margins. So you rightly said it's slightly better as compared to Q3 numbers.
Just Bunty, in terms of one-offs, whether it's the Credila sale, ex-gratia employee payments, floating provisions. Now, the question is this skewing the way we're looking at the numbers right now?
Yeah, as you rightly said, but we will take it as a more positively, because if you have seen 7,300 crores of profitability from Credila, which has been utilized for much of the better in terms of floating provision, which is much higher than around 10,900 crores. And floating provision, the positive is that it does not show there has been a stress. If you have moved to the contingent provisions, then we could have seen that there has been a stress which should be utilized. But the positive over here is for floating provision, you need approval from the RBI to utilize it. And they were very confident in the management commentary. We don't see any kind of a stress for next 3 to 5 or 7 years in terms of on the asset quality. So they won't be require any floating provisions. And this gives the buffer in terms of balance sheet strength going forward with respect to balance sheet strength.
Okay, Bunty, just one thing. How are you pricing in margin recovery for HDFC Bank, considering that, liabilities, deposits, replacement happens, and this whole narrative that NIMs will contract at some point of time because of rate changes that might happen, but that assumption might now be challenged for the better part of 2024, if not the whole of 2024.
Yeah, as you rightly said, for FY25, you see they have said from FY25 onwards, you have a high cost borrowings from the HDFC Limited, which will be replaced from the deposit part. And we know deposits rates is much better than your high cost borrowings from the HDFC Limited. So that is the positive. As soon as that get repriced or replaced with the deposit rate, you will get a bump up or you will get a positive impact on the net interest margin. Though on a conservative side, currently, if you see, everybody's estimating not much of an improvement. But as soon as the market gets the confidence in terms of numbers next 2 to 3 quarters, how that has been reshaping, the market will take it positively.
Bunty, what do you make of the 10,900 crores of provisions? Is that a concern? Let's not forget that they've always provided for 0.5. Even though it's a floating provision, it has and holds a lot of benefits as well. What do you make of that? Is that something you're worried about at this stage, or no surprises there?
So as I've said, the management was very clear. If we have moved to the contingent provisioncy, that there could be possibility of seeing some stress in the balance sheet. So they are providing it now. But as I've said, floating provisions require prior approval from the RBI to utilize it for the balance or for the P&L part. So that shows the strength, that shows the confidence from the management that floating provisions we don't require. We are just strengthening the balance sheet per se.